In investments, risk and reward are two sides of the same coin. High returns often involve more risk. But what if we could manage the downside more effectively? Enter the Sortino Ratio, a tool focusing on downside risk. It offers a clearer picture of potential negative surprises. Understanding it helps align your portfolio with your goals. This metric can empower you to build a resilient portfolio. The Sortino Ratio is a risk-adjusted return measure that sets itself apart by focusing solely on the downside risk of an investment. Unlike the widely used Sharpe ratio, which considers both upside and downside volatility, the Sortino Ratio zeroes in on what matters most to investors: the potential for losses. The Sharpe ratio penalizes both positive and negative volatility, treating them equally. However, investors generally welcome upside volatility or gains, while downside volatility or losses is what keeps them up at night. The Sortino Ratio addresses this by specifically measuring the volatility of returns below a target or minimum acceptable return, which is typically set by the investor based on their risk appetite. By isolating downside risk, the Sortino Ratio provides a more nuanced view of an investment's risk-return profile. It allows investors to compare different investments based on their potential for negative returns, helping them make more informed decisions aligned with their risk tolerance. Downside risk is the potential for an investment to lose value. It's the fear of seeing your hard-earned money dwindle that keeps investors awake at night. While upside potential is exciting, it's the downside that can truly derail your financial goals. Different investors have different levels of risk tolerance. Some are comfortable with greater fluctuations in their portfolio, while others prioritize capital preservation. Understanding your own risk tolerance is crucial when making investment decisions. That's where the Sortino Ratio shines. By focusing on downside risk, it helps you evaluate investments based on your comfort level with potential losses. A higher Sortino Ratio indicates lower downside volatility, meaning the investment is less likely to experience significant drops in value. This makes it a valuable tool for investors who prioritize protecting their capital while still seeking reasonable returns. Section 4. Calculating the Sortino Ratio. A step-by-step guide. Calculating the Sortino Ratio might seem daunting, but it's straightforward. First, gather historical returns. Collect a series of historical returns for the investment. Next, determine your minimum acceptable return, or MAR. Then calculate downside deviations. Calculate the average downside deviation. Take the square root of this average. Finally, calculate the Sortino Ratio. Subtract the risk-free rate from the average return and divide by the downside deviation. Online calculators can simplify this process. Once you have your Sortino Ratio, you can use it to compare different investments and make informed decisions based on your risk tolerance.